All right, so you're looking into the SPDR S&P 500 ETF Trust.
Or SPY as it's known.
SPY, yeah.
Out there on the street.
Smart move.
It's one of the most popular ETFs out there. And
for good reason.
Yeah, for good reason. Gives you a piece of 500 of the biggest U.S. companies all in one shot.
But we're going beyond just the buy and hold talk today.
That's right.
We've got the Trust's annual report from September 30th, 2024, and its schedule of investments.
Yeah.
That's where the real story is.
That's where the story is. We're going to break down what this ETF actually owns, how it performed this past year.
Okay.
And get this, we'll even uncover some surprising stuff like investments in affiliates.
Oh, interesting.
Plus, you'll get a real feel for the overall U.S. market makeup as of this year.
By the end of this deep dive, you'll not only understand this ETF inside and out,
yes,
but you'll also have a much clearer view of the U.S. market.
Absolutely.
Who knows, maybe even some new investment ideas to explore. Okay, let's get started.
Let's do it.
Now, the SPDR, S&P 500 ETF Trust, aims to match the performance of the S&P 500 index, right?
Right.
But how does it actually do that?
So it's all about mirroring the index's composition.
Okay.
Think of it like this. If Apple makes up, say, 5% of the S&P 500's total value, then SPY will hold roughly 5% of its assets in Apple stock.
So it's all about...
It's a straightforward strategy.
Proportion.
Yeah, but very effective in tracking the market's movements.
Now everyone wants to know about performance.
Of course.
How did the trust actually do over the past year?
Well, it posted a 12-month return of 36.15% ending September 30th, 2024.
Okay, that's it.
Solid return.
Not bad.
But you mentioned it's slightly less than the S&P 500's actual performance. Why is that?
Right. The S&P 500 returned 36.35% over the same period.
Okay.
That little difference comes down to what it costs to run the ETF.
Gotcha.
Things like administrative fees, trading fees.
Makes sense.
They eat into the returns just a tiny bit.
But there's also mention of an expense waiver in the report.
Yes. What's the deal with that?
So that's a tactic some ETFs use to boost their performance figures and attract investors.
I see.
By temporarily waiving some fees, they can make their returns look a bit better than they would be otherwise.
Interesting.
It's not necessarily a bad thing, but something to be aware of when comparing different ETFs.
So even something as simple as an expense waiver can have a noticeable impact on an ETF's performance.
Exactly.
Now let's dive into the schedule of investments.
Oh.
It's basically a detailed list of everything the ETF owns, right?
Exactly. And it's more than just a list.
Okay.
It's a snapshot of what's driving the U.S. economy.
Okay.
For example, as of September 30th, 2024, the ETF's top holdings include Apple at a whopping $42 billion, followed by Microsoft at $38 billion.
Huge.
And Amazon at $21 billion.
Okay.
NVIDIA is also up there with a value of $36 billion.
So you'll notice a trend here.
It's starting to... Tech is king.
Yeah.
Absolutely.
It definitely seems that way.
Yeah.
It's striking how much of the ETF's value is concentrated in these tech giants. But wait, I see Tesla in there too?
Yes.
Marked with an A.
Good eye.
What does that mean?
That A stands for non-income producing security.
Okay.
Essentially means Tesla doesn't pay dividends.
Okay.
You might be wondering why that matters.
Yeah, I am.
Well, dividends are payments companies make to shareholders, usually from their profits.
Right.
So for an ETF that's trying to match the S&P 500, which does include dividends, holding a large chunk of a non-dividend paying stock like Tesla is a bit curious.
That is interesting. It seems a bit counterintuitive.
Guys, a little bit.
Are they maybe betting on Tesla's future growth even though it's not paying out dividends right now?
It's possible. Remember, Tesla's a relatively new addition to the S&P 500.
Oh, that's right.
Perhaps the ETF managers are still adjusting their strategy to accommodate a company like Tesla.
This schedule of investments is revealing a lot more than I initially thought. Now, speaking of insights, what about the overall industry breakdown?
Okay.
What's the bigger picture of the market looking like?
Well, if the top holdings didn't make it clear enough, the industry breakdown confirms tech is dominating the U.S. market in 2024.
Really?
Semiconductors take the top spot, making up 11.1% of the ETF's assets.
Wow.
Software is close behind at 10.3%.
Okay.
Followed by tech hardware at 7.7%.
So even though this ETF is designed to track the broad market, it's clear that certain sectors like tech are having a much bigger impact on its performance than others. But it's not all about the big players.
Right.
I noticed a really small percentage allocated to gas utilities, Like almost nothing.
You're right. Gas utilities come in at a measly 0.0%.
Really?
It might seem insignificant, but even those tiny details can tell us a lot about larger trends. In this case, it speaks to the changing energy landscape and how investors are shifting their focus away from traditional energy sources.
It's amazing how much information you can glean from these financial reports if you know where to look.
It is. It's amazing.
Now, there's one more thing from the report I want to dig into.
Okay.
The section about investments in affiliates of the trustee and sponsor.
All right.
Can you explain what that means and why it matters to us?
Of course. So this is where things get a little more complex.
Okay.
The ETF actually holds shares in companies that are affiliated with the trustee and sponsor of the ETF.
Wait, so the ETF is investing in companies that have ties to the very entities that are supposed to be managing it?
Yeah, we're talking about State Street Corp.
Hold on. Isn't that a potential conflict of interest?
It's definitely something worth paying attention to.
Okay.
On the one hand, these holdings are fully disclosed in the report, and they only make up a small part of the overall portfolio.
But even if it's disclosed, it still feels a little off, doesn't it?
It can, yeah.
Like, is it possible that those relationships could create a bias in decision-making?
Yeah.
Could the ETF prioritize the interests of its affiliates over the interests of its investors?
That's the potential conflict of interest we need to be aware of. It's something regulators are keeping an eye on as well, making sure there are safeguards in place to protect investors.
So it's not necessarily a red flag.
Right.
But it's definitely something investors should be aware of and consider carefully.
Absolutely.
What are the specific numbers on those affiliate holdings?
Okay.
I'm curious to know just how much is invested there.
As of September 30th, the ETF held over 3.6 million shares of State Street Corp, valued at $319 million.
Okay.
And the stake in Intercontinental Exchange is even bigger. Almost 7 million shares worth over $1.1 billion.
Wow, those are significant numbers.
They are.
This deep dive's already getting really interesting.
I told you.
We've gone beyond the surface level and uncovered some thought-provoking details about this popular ETF.
Absolutely.
But we're not done yet.
Nope.
There's still a lot more to unpack and analyze, especially when it comes to those affiliate holdings and what they might mean for investors like you.
Right.
So stay tuned as we continue this deep dive into the SPDR S&P 500 ETF Trust.
Absolutely.
We'll be right back after a quick break.
Welcome back to our deep dive into the SPDR S&P 500 ETF Trust.
We've already uncovered some really interesting details about this popular ETF.
We sure have, and one of the biggest things that stood out to me was the fact that this ETF, which is supposed to be all about tracking the broad market, is actually pretty heavily concentrated in the tech sector.
You're absolutely right, and that raises an important question. Is the S&P 500 really as diversified as many people believe?
Yeah, that's a good point. We tend to think of the S&P 500 as this well-rounded representation of the U.S. market.
Right.
But when you see how much weight is given to just a handful of tech companies, it makes you wonder
exactly what happens if those tech giants stumble.
Right.
It could have ripple effects throughout the entire market, and your portfolio could feel it. That's a little unsettling. It seems like diversification is still crucial, even when you're investing in a broad market ETF like SPY.
Yeah, absolutely. Don't let the name S&P 500 fool you into thinking you're automatically diversified. It's crucial to understand what's actually in the index you're investing in and how those holdings might affect your overall portfolio.
Now let's circle back to those affiliate holdings we discussed earlier.
Okay.
You explained that the ETF owns shares in companies connected to the trustee and sponsor.
Right.
Help me understand the potential implications here. Is this something investors should be concerned about?
It's a valid question, and there are a couple of ways to look at it. On the one hand, these holdings are fully disclosed in the reports. Transparency is key in the financial world, and at least you know what you're getting into.
That's true.
Yeah.
But even if it's disclosed, it still feels a little off, doesn't it? Is it possible that those relationships could create a bias in decision-making? Could the ETF prioritize the interests of its affiliates over the interests of its investors?
That's the potential conflict of interest we need to be aware of. It's something regulators are keeping an eye on as well.
Okay.
Making sure there are safeguards in place to protect investors. But ultimately, it's up to each individual investor to decide how comfortable they are with this type of arrangement.
It's definitely something to consider when choosing an ETF. Now, another thing that caught my attention was that large position in Tesla, which we know doesn't pay dividends.
Right.
For an ETF that's supposed to track both the price A and D yield of the S&P 500, It seems a bit odd, right?
You're right. It is a bit peculiar. You'd expect an ETF aiming to mirror an index that includes dividends to be fully invested in dividend-paying stocks. It raises the question, why hold such a significant amount of a non-yielding asset?
Exactly. It seems like it would drag down the overall yield of the ETF.
Well, it's possible the ETF managers are making a calculated bet on Tesla's future growth potential. They might believe that even though Tesla isn't paying dividends right now, its stock price will appreciate significantly over time, making up for that lack of current income.
So they're potentially prioritizing long-term capital gains over current income.
Exactly. It's a growth-oriented strategy. Remember, Tesla is a relatively recent addition to the S&P 500.
Right.
Maybe this is a temporary situation as the ETF adjusts its portfolio to fully reflect the index's changes. It'll be interesting to see how this plays out in future reports.
It's a good reminder that even seemingly straightforward ETFs can have these nuances and complexities.
Absolutely. And that's why these deep dives are so valuable. We're going beyond the surface level and uncovering the stories behind the numbers. These stories can give you a much deeper understanding of your investments and help you make more informed decisions.
Speaking of informed decisions, let's shift gears for a moment and revisit that notation we saw next to certain companies in the schedule of investments. We talked about Tesla, but there were others as well.
Right.
What does this mean for investors who might not be familiar with this kind of financial jargon?
It's a great point. It highlights the importance of understanding the language of investing. That A is essentially a shorthand way of saying that a stock doesn't pay dividends. So if you're someone who relies on dividend income for a portion of your portfolio, you'll want to pay close attention to these notations.
Right. You wouldn't want to invest in an ETF that's heavily weighted towards non-dividend paying stocks if you're depending on those regular payouts.
Exactly. It's all about aligning your investments with your personal financial goals and risk tolerance. Are you seeking growth income? Or a combination of both? Understanding these basic concepts is crucial for building a portfolio that meets your specific needs.
This deep dive isn't just about dissecting the SPDR S&P 500 ETF trust. It's about equipping you with the knowledge and tools to be a more informed investor across the board.
Precisely, we're empowering you to ask the right questions, understand the complexities of the market, and make decisions that are right for you.
Now let's zoom out a bit and consider the bigger picture. We've been focusing on this specific ETF. But are there any broader lessons we can draw from this deep dive? What can we apply to our overall investment strategy?
One of the biggest takeaways is the importance of looking beyond the surface level.
Right.
Don't rely solely on marketing materials or performance figures. Take the time to read the reports, understand the underlying holdings, and assess the potential risks and conflicts of interest.
So it's about being an active and engaged investor, not just a passive bystander.
Exactly. Knowledge is your best defense against costly investment mistakes. Another key takeaway, as we discussed earlier, is the importance of diversification.
Right.
Don't put all your eggs in one basket, even if that basket is a broad market ETF like the S&P 500. Spread your investments across different asset classes, sectors, and geographies to mitigate risk.
And finally, don't be afraid to ask questions and seek professional advice if you need help navigating the complexities of investing.
Correct.
There's no shame in admitting you don't know everything. In fact, it's a sign of a smart investor.
Absolutely. We're all on this journey together, learning and growing as we go. This deep dive has been incredibly insightful, shedding light on not just the SPDR S&P 500 ETF trust, but also on broader investment principles that are relevant to everyone.
We've learned a lot about the importance of informed decision-making in the investment world and how to really dig into those financial reports to uncover the stories behind the numbers.
And we're not done yet. Stay tuned for the final part of our deep dive, where we'll wrap things up with some thought-provoking questions and leave you with some food for thought.
Welcome back to the final part of our deep dive into the SPDR S&P 500 ETF trust.
Yeah.
We've really dug deep into the details of this popular ETF
Yeah.
and explored some of the broader implications for investors like you.
Absolutely.
And now it's time to kind of bring it all together.
Yeah.
And leave you with some food for thought.
All right.
Remember that question we raised earlier about the diversification
Oh, yeah.
of the S&P 500?
The one about whether it's truly as diversified as many investors assume.
We saw how dominant the tech sector is within the ETF's holdings.
Yeah.
And then there's the fact that the ETF invests in affiliates of its own trustee and sponsor.
Uh-huh.
What if these are actually signs of a deeper issue?
It's a thought-provoking question. What if the S&P 500 is becoming increasingly concentrated in a way that many investors haven't fully realized?
Right.
The index is often seen as the gold standard for diversification.
Yeah.
But that assumption might need to be re-examined.
It could have major implications for those relying on the S&P 500 for broad market exposure and risk reduction.
Yes.
If the index is becoming more concentrated, investors might need to adapt their strategies.
Yeah, they might want to consider diversifying beyond the S&P 500.
Okay.
Perhaps by exploring other asset classes, or maybe by taking a more active role in managing their portfolio.
So maybe not just the traditional buy and hold.
Yeah, the traditional approach of simply buying and holding the S&P 500 might not be enough in this evolving market.
It's a call to action for investors to be more proactive.
Yes.
More discerning and more informed about the potential risks and opportunities in the market.
Absolutely. Don't be complacent. Challenge assumptions. Dig deeper.
Yeah.
And be prepared to adjust your investment approach as needed.
The market is constantly changing.
Always.
And so should your strategies.
Absolutely.
And that's what the Deep Dive's all about.
That's right.
We're not just providing information. We're empowering you to think critically, ask the right questions, and make informed decisions that align with your own unique goals and risk tolerance.
Remember, the learning never truly ends.
It doesn't.
There's always more to explore and uncover in the world of finance.
Right.
Stay curious, stay engaged, and keep seeking knowledge. That's the best way to stay ahead of the curve and achieve your financial aspirations.
We hope this deep dive into the SPDR S&P 500 ETF Trust has been enlightening and empowering for you.
We hope so.
We've uncovered some surprising details, analyzed complex concepts, and hopefully provided you with a new perspective on this popular investment vehicle.
And remember, this is just the beginning of your journey. There's a whole universe of financial knowledge out there waiting to be explored. Keep diving, keep questioning, and keep learning. We'll be here with you every step of the way, providing the insights and perspectives you need to navigate the ever-changing market.
Thanks for joining us on this deep dive.
Yes, thank you.
Until next time, happy investing.